Canada is quietly becoming the safer payment lane as 6 countries start shifting trade away from automatic US dollar dependence under President Donald Trump's tariff pressure. The move, unfolding over recent weeks across North America, Europe, and Asia, reflects a growing effort to reduce exposure to Washington's trade retaliation and payment system leverage. What is happening is not a formal break with the United States, but a practical workaround. Importers and exporters in 6 economies are increasingly exploring Canadian dollar settlement, according to trade and financial market observers, as a way to keep deals moving without getting caught in the crossfire of Trump's tariff escalation. In plain English, if the U.S. keeps acting like the payment room's Karen, countries are looking for a quieter door. The shift matters because the US dollar has long been the default currency for cross-border trade, even when America is not directly involved in the transaction. That setup gives Washington enormous influence, especially when tariffs, sanctions, or banking restrictions enter the chat. Under Trump's latest tariff pressure, however, some governments and companies appear to be asking a basic question: why keep routing everything through the loudest, most unpredictable player in the room? Canada is benefiting from that question in a very specific way. Its currency is widely traded, its banking system is stable, and it sits close enough to major trade corridors to function as a practical settlement option without the political baggage of the US dollar. For businesses trying to avoid sudden policy shocks, Canadian dollars are starting to look less like a niche alternative and more like a safer middle ground. The change is still early, but the direction is clear. 6 countries do not move away from dollar dependence by accident, and they do not do it when they feel confident the old system is working in their favor. They do it when tariffs, retaliation, and political pressure make the old route feel less like convenience and more like risk management. That is where Canada enters the picture as the quiet winner. While Trump has leaned on tariffs as a pressure tactic, the response is not just counter tariffs or angry headlines. It is structural adaptation. The real question now is why Canada is suddenly the safer payment choice. Canada is turning a tariff mess into a trade advantage, and the reason is not hype. It is plumbing. Its G7 currency, deep banking system, and legal credibility are making the Canadian dollar a practical settlement corridor for companies trying to move money without getting caught in Washington's crossfire. Unlike a symbolic alternative, Canada offers the kind of stability traders actually use. The Canadian dollar is freely traded, widely recognized in global markets, and backed by a central bank that has spent decades keeping inflation expectations anchored. For importers and exporters, that matters more than political theater. Settlement only works when counterparties trust the currency will hold value, clear cleanly, and not get dragged into the next policy tantrum. The trust is also institutional. Canada's major banks are among the most tightly regulated in the developed world, with strong capital buffers and a reputation for not turning every payment channel into a drama series. In a world where Trump's tariff threats can change the mood overnight, companies are looking for a system that is boring in the best possible way. Canada's financial architecture fits that brief, which is exactly why it is being treated less like an outsider and more like a reliable middle lane. The legal side matters just as much. Cross-border trade settlement depends on predictable contracts, enforceable rules, and courts that do not feel like they are improvising in real time. Canada's commercial framework gives firms a level of confidence that is hard to replicate when the U.S. is using tariffs as leverage and turning trade into a pressure campaign. That predictability is not glamorous, but in finance, boring is often the highest compliment. Then there is the real economy behind the currency. Canada is not just a paper option. It is a major exporter of energy, metals, agricultural products, and industrial inputs that global supply chains actually need, that gives the currency a practical anchor in real goods, not just financial sentiment. When a trade route is tied to actual resources, settlement in that currency starts to look less like a workaround and more like common sense. This is why the shift is not about Canada pretending to replace the United States. It is about Canada being useful where the U.S. has become costly. Trump's tariff strategy may still force headlines, But it is also pushing companies to favor payment channels that reduce exposure to sudden retaliation. And Canada is sitting in the sweet spot: close, trusted, liquid, and not politically radioactive. Market observers say that combination is what turns an option into a habit. A business that settles one shipment in Canadian dollars because it is faster or safer may do it again on the next contract, then the next, until the workaround starts looking normal. That is how convenience becomes routine and routine becomes dependency. How did convenience turn into a financial habit? Canada is emerging as a practical settlement option for trade flows involving Indonesia, Vietnam, Bangladesh, Kenya, Ecuador, and the United Arab Emirates, as companies look for currency channels that can handle food, energy, minerals, and financing without extra political friction. In each case, the appeal is not symbolism but utility. Canadian dollar settlement can match the real needs of exporters, importers, lenders, and commodity buyers trying to keep contracts moving. Indonesia offers the clearest example on the commodity side. As one of the world's largest suppliers of nickel, palm oil, and coal, it needs payment systems that can move quickly across long supply chains, especially when buyers are balancing energy security and industrial demand. A Canadian dollar corridor fits that pattern because it can sit between resource producers and North American or global counterparties without forcing every transaction through the same US-centric channels that have become more politically exposed. Vietnam points to the manufacturing and food processing angle. The country's export base depends on steady access to machinery, packaging inputs, agricultural commodities, and intermediate goods, which means settlement has to be reliable rather than flashy. For firms trading with Canadian buyers or Canadian-linked financiers, using the Canadian dollar can reduce friction in contracts tied to seafood, coffee, electronics components, and processed food shipments, especially when the goal is to avoid extra exposure to tariff shocks and payment delays. Bangladesh shows why financing matters as much as goods. Its economy relies heavily on apparel exports, imported fuel, and large-scale trade credit. So even small gains in settlement predictability can matter for working capital. Canadian dollar invoicing can help lenders and buyers structure deals around a stable currency while keeping transactions flexible enough for textiles, grain imports, and energy purchases, which is exactly the kind of boring efficiency trade desks love and politicians usually ignore. Kenya brings the story into food and infrastructure financing. The country imports fuel, fertilizers, and industrial equipment, while exporting tea, coffee, flowers, and other agricultural products that depend on timely payments. A Canadian dollar settlement route gives banks and traders another option for matching commodity flows with credit lines, especially when financing has to move alongside freight, insurance, and seasonal crop cycles. Ecuador is a useful test case because its trade is heavily tied to food and energy logistics. The country's exports include bananas, shrimp, cocoa, and crude, all of which depend on fast settlement and tight margins. Canadian dollar use can support those flows by giving counterparties a currency that is liquid enough for settlement and credible enough for contracts, while also making it easier to finance shipments without overloading US dollar channels that can become crowded or politicized. The United Arab Emirates adds the minerals and global finance layer as a re-export hub with deep links to energy, metals, and sovereign capital. The UAE is built for multi-currency trade, not one-size-fits-all settlement. Canadian dollar transactions can fit neatly into that ecosystem when buyers are moving minerals, industrial inputs, or structured financing across regions, because the currency works as a practical bridge rather than a political statement. What ties these cases together is the same basic logic. Food needs reliable settlement, energy needs scale, minerals need trust, and financing needs flexibility. Canada is benefiting because its currency can serve all four at once, which makes it useful to traders who want fewer surprises and less exposure to Trump-era trade retaliation. Which sector is quietly locking Canada into trade flows? Canada is turning trade settlement into a quiet power move, and the ripple effects are now showing up in contracts, banking services, exporter pricing, and reserve monitoring across multiple markets. As more counterparties test Canadian dollar invoicing and settlement, the currency is no longer just a payment tool. It is becoming a corridor that can reduce automatic dependence on the US dollar and blunt some of the pressure coming from Trump-era trade politics. The first link in that chain is the contract itself. Once buyers and sellers agree to price goods in Canadian dollars, the settlement logic changes from the start because the currency risk, payment timing, and financing terms are all built into the deal rather than patched in later. That matters for exporters that want predictable margins and for importers that want fewer surprises when tariffs, shipping costs, or political shocks hit the invoice. Banks are following that shift fast because settlement volume creates business, and business creates infrastructure. Canadian lenders and trade finance desks can offer letters of credit, hedging, and payment processing in a currency that is stable enough for large transactions and flexible enough for cross-border trade. In practice, that means firms do not need to route every transaction through US-centric channels that can be slowed, priced up, or turned into leverage. Whenever Washington wants to play hardball, exporter pricing is where the adjustment gets even more visible. Once a supplier starts quoting in Canadian dollars, it can separate product pricing from US dollar volatility and reduce the need to constantly reprice shipments around tariff threats or exchange rate swings. For commodity sellers, manufacturers, and food exporters, that can make bids cleaner, contracts easier to enforce, and margins less exposed to the kind of policy whiplash Trump has. Used as a negotiating tactic, the reserve side is the part Washington cannot ignore. Because settlement patterns eventually show up in central bank behavior, if trade flows increasingly settle in Canadian dollars, reserve managers have to watch whether counterparties begin holding more CAD for working capital, backup liquidity, and payment buffers. That does not mean the US dollar is being replaced overnight, but it does mean the automatic default to dollar dominance is no longer automatic, which is exactly the kind of incremental shift that makes policymakers nervous. For Canada, the advantage is not theatrical, it is mechanical. Every contract signed in CAD, every bank service built around CAD, every exporter that prices in CAD, and every reserve manager that has to monitor CAD. Exposure adds another layer to a settlement network that works without asking Washington for permission. That is why the Trump factor matters so much here. His tariff-first approach pushed more firms to look for payment routes that are less vulnerable to US political pressure, and Canada is benefiting from that search for alternatives. The result is a trade settlement lane that looks boring on paper but carries a bigger strategic message underneath. If the US keeps using finance as a weapon, more partners will keep building ways around it. Washington sees that as a warning because the damage is not immediate, it is structural. A currency does not have to collapse to lose influence, it only has to become optional. Canada is turning Trump's tariffs into a business case for diversification as companies and governments respond to coercive US trade policy by looking for a non-coercive alternative. The shift is visible in contracts, banking behavior, and reserve planning, where Canadian dollar settlement is increasingly being treated as a practical hedge against political volatility. That is the part Washington does not like to say out loud. Tariff pressure can force the very behavior it is meant to prevent. When the US makes market access feel conditional, counterparties start asking a simple question: why keep building around a system that can be weaponized on demand? Canada's appeal in that environment is not ideological, it is operational. Firms that want predictable settlement, lenders that want stable transaction flows, and exporters that want fewer political surprises are finding that Canada offers a cleaner lane than a tariff regime that changes with Trump's mood and campaign messaging. The contrast is doing the real damage. Trump's trade policy relies on leverage, escalation, and the threat of disruption. But that same playbook pushes partners to reduce dependence on US-centered channels. In plain English, the harder Washington squeezes, the more rational it looks to route around Washington. That does not mean partners are abandoning the United States overnight. It means they are building options, and options are poison to a strategy built on coercion. Once firms, banks, and reserve managers decide they need backup routes, The US loses the one thing it has always counted on most: automatic default behavior. For Canada, that is a quiet win with loud implications. The country does not need to outshout Trump. It only needs to keep offering a system that works without threats, penalties, or public humiliation. In a world where tariff shocks keep raising the cost of loyalty, that kind of reliability starts to look like leadership. The bigger question is whether Washington understands the damage before it hardens into habit. If the US keeps using tariffs as a reflex, more partners will keep treating Canada as the safer place to do business. And once that habit sets in, it will not be easy to pull back. Can the US still reverse this quiet shift? Canada is emerging as the cleaner answer to Trump-era trade volatility, and the result is a global payment system that looks less exclusive than it did a year ago. The US dollar still dominates cross-border finance. But Canada is gaining influence as companies, banks, and governments look for a settlement option that does not come with political strings attached. That matters because dominance and exclusivity are not the same thing. The dollar remains the main reserve and invoicing currency for most of the world, yet the growing use of Canadian dollar settlement shows that market participants are no longer willing to treat Washington as the only safe default. In practical terms, that means the United States keeps the top seat, but it no longer gets the whole table to itself. For Canada, the upside is strategic, not symbolic. By offering a trusted, rules-based channel for settlement, Ottawa is positioning itself as a financial bridge for partners that want predictability without the drama. That gives Canada more leverage in trade talks, more relevance in banking relationships, and a stronger role in the quiet machinery of global commerce. The shift also exposes a broader weakness in Trump's approach. Tariffs may still create short-term pressure, but they also accelerate the search for alternatives, which is exactly how a coercive strategy backfires. Every time Washington turns access into a threat, it gives other countries another reason to reduce dependence and spread risk. That is why the Canadian option is gaining traction beyond simple hedging. It is not being adopted because it is louder than the dollar, but because it is less volatile than a policy regime that can change overnight. In that sense, Canada is not trying to replace the United States. It is taking advantage of the space Trump keeps creating. The likely outcome is a more fragmented settlement landscape, not a sudden dollar collapse. The US dollar still anchors the system, but more transactions can now move through Canada when counterparties want a non-coercive route. That is a meaningful change, because once a trusted backup becomes normal, it starts to look less like a backup and more like a standing option. Economists say that kind of shift rarely happens all at once. Reserve currencies lose monopoly power gradually, not in one dramatic break, one currency strategist told reporters, adding that the key question is whether users keep building habits around the alternative. For Canada, the answer is already moving in its favor, while Trump's tariff strategy keeps doing the one thing it was supposed to prevent: pushing partners away. So the final picture is clear. The dollar remains dominant, but no longer exclusive. Canada is gaining influence, and the world is gaining a settlement option it can trust when politics gets messy. The only question left is whether this is a temporary inconvenience for Washington or the beginning of a lasting reset.